Good morning. This is Larry McMillan with a market update on Monday, January 10th, just about the time the market is opening. So last week saw S&P slip back below the 4,700 level, and that's a big negative. I mean, that means last week's upside breakout to 4,800 was a false breakout, and we're now back in the old trading range, which roughly went from 4,500 to 4,700. This morning, there's been a lot of follow-through selling as I think people are digesting that and also seeing the negative internals in this market. So there's an old adage that if you break December's lows, you're in a bear market. The December lows are from early December, and they're around 4,500 on the S&P. QQQ, on the other hand, is already breaking December lows. That's actually probably the worst performing index of the four major ones. The Dow is the best performing right now, as it even had positive breadth on Friday when no one else did. And then the Russell 2000, or IWM, is somewhere on the negative side, but really not quite as bad as QQQ is right now. We're looking at support, as I said, at 4,500, maybe just a little bit above that. If that gives way, then 4,300 would be your next stop. Equity-only put-call ratios are now split. The standard ratio has reverted to a sell signal. The weighted ratio, while curling upwards and looks pretty bad to the naked eye, the computer analysis programs are still saying that's on a buy signal. Well, we'll see about that. Market breadth was poor last week, especially in broad-based terms, and both of our breadth oscillators are on sell signals now. So that means that the market's under some pressure here. These are the first sell signals from that indicator since mid-November, and they were pretty good sell signals back then. New highs versus new lows in all three categories. New lows have moved ahead now. So that's bearish as well, even on the New York Stock Exchange. Not by a lot of issues, but by a few. And it's much worse in terms of NASDAQ or stocks-only data. Even VIX is not giving the clear, robust buy signals that it normally does. VIX has gone into what we call spiking mode, and it will eventually give a VIX spike peak buy signal. That will come when it makes a high here in the next, today is its highest move so far on this, in the last week. If it pulls back more than 3 points from there, that would be a buy signal. The trend of VIX has also turned negative now in that both VIX and its 20-day moving average are above the 200-day. But the one volatility indicator that remains solidly bullish is the construct of volatility derivatives. The futures term structure slopes upwards in the VIX futures, and that's positive for stocks. So all in all, we're removing the core bullish status from the SPX chart because it's fallen back into this trading range. And so while we're in this trading range, and really if you think about it, we've kind of been in a trading range since mid-November. There hasn't been a lot of follow-through in either direction. So we will continue to trade individual signals as they occur. And as I mentioned, a break of the December lows would be very bad for, just things in general. And we'd probably have to work off some substantial selling if that happens. But otherwise, we're in this trading range. You can play signals from both sides. So I invite you to visit our website, take a look at our newsletters where we follow these things daily. And good luck and good trading.